we going to break out? When are we going to break out? Are we breaking up or are we breaking down? Graham covered a little bit of his analysis yesterday, kind of projecting those outcomes, most of which we're pretty aligned on. And one thing that I'm very interested to see is if we see Bitcoin kind of front running that risk on environment. Bitcoin obviously ripped to new highs, but we were still in a very tight consolidation range in the SPY, the Qs, whatever index you want to use. Again, from that July 3rd high, which, hey, by the way, on Opening Playbook, we projected July 3rd, the most bullish day of the calendar year. And so it lived up to that and was very bullish. And since then, we've been incredibly tight consolidation. And so I'm curious to see kind of when we get some action here, and if it's a little bit of a hint of what Bitcoin did that drives us with some risk on appetite to the upside. Hey, Graham.
Hey.
Speaking of Bitcoin, I'm going to give you a trade idea here in a couple minutes that is Bitcoin related. Excuse me. That I think will be an interesting one. So keep an eye out for that. We'll put that together. We've got a packed session. I'm going to do a bit of a strategy training, one that I think is interesting for today's environment. Something that you can put on and pretty much monitor non-directionally, which I think right now, again, if you're prepared for breakouts in both directions, probably a good thing. I'm pretty bullish, as you guys know, but obviously want to be prepared for that. So I'm going to do kind of a quick overview training. We'll probably do a more in-depth training on a different Opening Playbook session on this same concept. And then I'm going to give you one trade idea related to that. And then we've got the one and only Tom Busby on today, who's going to join, actually is on already, that beautiful white hair I can see right now. Hi, Tom. And Tom is going to be jumping on after mine and going to dive in a little bit to the 24-hour markets. And then one particular thing that he's looking for in the pre-market that gives us a little bit of a head start or a snapshot of potential opportunities. So packed session today. Hope you guys are taking notes and dialed in. We'll get started. Obviously, chat is open. If you guys want to chat with everyone, you just change that little blue box to everyone right above where you're typing. If you want to chat for everyone to see it, and you can do that. All right, let's get rolling. Morning, Lee, Sean, Joshua, Joseph. Hi, Mike. Hello. Laura, Barb, Babette. Hello, hello, hello. Hope you guys are doing well. All right. So what I'm going to do, guys, I'm going to give you, hey, John, Art, Barry, Dave, Pete, hi, Sharita. I'm going to give you an overview of this profit pair strategy. Now, profit pairs is a strategy, as we'll talk about here, where you can look to trade in different directions at the same time using different assets. And the reason that I think it's interesting today is that while the market's not doing a whole lot right now, overall, the index is pretty quiet. I think there's a good opportunity for us to get a momentum breakout. ATR, that's the average range, will typically expand, then it will typically shrink, and then it'll typically expand again. And so I expect as we're shrinking down here that we'll get a move that expands back out. Now that's a special opportunity for options traders. Okay? If the ATR is low, options prices are going to be lower because there's not a lot of movement that you're having to pay for implied volatility. And then if they expand out, now the stocks are going to move a lot relative to what you paid for the option. The opposite is true as well, right? We warned about this when the market was collapsing and moving 6% a day. Graham and I were saying, hey, be very, very careful buying options. Why? Because you're paying the absolute peak implied volatility. You're paying for options based on stocks moving 8% a day. But the most likely thing is for stocks to actually shrink down and slow down. And now you will have paid all this money for these expensive options while stocks are slowing down, which is the hardest environment to make money on regular options. What we're talking about now is ATRs are lower, options are becoming more reasonably priced, but potentially we're going to see those movements explode and you'll actually have outsized returns. The problem is you might not know which direction they're going to go. And that's why we're talking about profit pairs. All right. Does that make sense to everyone? Give me a yes in the chat if you understand the framework of what I just described. And then I'm going to give you an overview of a strategy that I like to use in that situation called profit pairs. Like I said, we'll go through more of a general overview today, and we'll get a little deeper in previous or in follow-up sessions. All right. So basically what we're doing with profit pairs is we're using linked assets to trade in both directions at the same time. So what we're doing, excuse me, is we're always long one asset in a particular sector and short another asset in a particular sector. Now, what you're going to find out is that those are the same sectors. So if that sector goes up, we're long the stronger stock. If that sector goes down, we're short the weaker stock. And if the sector stays neutral, both stocks hopefully are going to continue their trend, and we actually have the opportunity to make money on both. They separate and continue their trend. So let's use Tesla and Rivian. This is one of my favorite examples to make the point. This is going back, this is like a couple of years of data, I think 2021 into 2024, just to give you an example of this that makes it simple. So two companies that are obviously very closely connected, right? They're both in the electric vehicle sector. Now, Rivian was in a clear downtrend all the way back in, again, this is like 2021 to 2023. I forget exactly what numbers, but this is just an example to give you the point. Rivian downtrend, Tesla uptrend. Hopefully everyone can see that there on the top and the bottom. Now, pretty much at any point throughout 2021, if you were short Rivian and you were long Tesla, you were going to make lots of money, right? You were short the weaker stock, you were long the stronger stock, you would have done incredibly well. In fact, both sides of the profit pair would have been profitable almost the entire year while being hedged at all times. So what do I mean by hedge? Well, obviously, I don't mean you can never lose, right? That's clearly not what I mean in this situation. What I mean is that you're in a position where major changes in the sector that you're trading will have a very high probability of impacting the pair together because you're always trading two stocks in the same sector. So big news, big shakeups are very likely going to affect those trades together. And this is extremely important because we've seen how other traditional quote-unquote hedges have failed investors as recently as 2022. Like when the 20-year bonds collapsed in 2022, not a very good hedge. Gold was down in 2022, not a very good hedge. Okay, so they're supposed to protect you when the market starts failing, but obviously did not do a very effective job of doing that. They both went down as the broad market also went down. So that's why I don't trust traditional hedges. Instead, I like to zero in on a specific sector because macro news for that sector is much more likely to impact both assets at the same time. And if macro changes don't affect both assets, well, then it's no hedge at all, right? So let me give you an extreme example just to make the point here. What if the government proposed legislation to ban electric cars? They said, hey, we got to vote in. They said, listen, by 2030, we want to ban all electric cars and no longer allow them in the United States. Would you guys say that that's going to affect both Tesla and Rivian if that legislation passed? Or it's just going to somehow affect Rivian but not Tesla? Well, hopefully you would agree it's going to affect both, of course, right? So that is an extreme example of how some major news is going to affect linked assets. So let's go ahead and flip back just to continue this example and go into 2022. Remember, all through 2021, you would have been making money hand over fist if you were short Rivian and long Tesla. In 2022, things changed pretty dramatically, right? Because we entered a bear market. Tesla quit dominating and began to lose value. So the long position on Tesla would have started losing money. But the beauty of profit pairs is that your Rivian position, where remember you'd be short, have puts, would have made up for the losses. So even in the bear market, you're still in good position. In fact, a typical option, again, I'm just using an extreme example here. If you shorted Rivian with a kind of typical option and just rolled it over every month there in 2022, you would have made about 400% on your Rivian puts, and you would have lost about 20% on your Tesla calls. Okay, so net, still a pretty good position. So even with Tesla going down and losing money, if you had $5,000 into all your Tesla calls, $5,000 into all your Tesla puts, you have netted about 19,000 during that 2022 bear cycle. So you still would have made about 350, 380% return in 2022. Now, here's one of my favorite examples from 2024 in the communication sector. So this is Dash versus Charter. Well, I was bullish on communications. You can see there, Dash was beating Charter. It was the stronger stock. So I was long on Dash and I was short on Charter. My expectation was to make money on the bullish side of the trade, right? Because we had momentum. But I had the other side just in case. But the way the trade worked out was exactly the opposite. Dash actually did a whole lot of nothing. It grinded right along, and Charter collapsed and generated a nice net profit. Okay, so do you see there? I was actually wrong about my direction. I was bullish on communications. The Charter trade was kind of my just-in-case position, but it turned out that Dash actually ended up not going anywhere, and Charter collapsed, and so I actually got the benefit of that on the bear side. My puts generated 82%, and my calls generated about 0%. That's a real trade, by the way, and that's exactly how it worked out. So the point is, either the stronger stock or the weaker stock can generate the profit on any given trade, and sometimes both do. So sometimes they both go up at the same time. Let's do one more example from June here, just last month on AMD versus ACN. So this was a bullish play on the tech sector because the tech sector was ripping in the back half of May and into June, and we expected more bullishness. I'm a momentum trader, so I like to trade the ones that are winning. And I wanted to pair two tech stocks to capitalize on that sector. Why did I want to do that? Well, if the tech sector continued to rally, AMD should win, right? AMD should carry the day because it's the stronger one. And if the tech sector took a hit, ACN should generate profit to the downside. Okay, pretty simple. If the tech sector is going to win, I like the strong stock. If it's going to fail, I should make money on the short stock. And by the way, if the tech sector remained neutral, remainder neutral, good spelling there, Nate. If the tech sector remained neutral, or just continued its current trend, then both stocks should have a good chance to continue their respective trends. In other words, if there's not a big macro force pushing the entire sector in one direction or the other, then they should maintain their respective trends. Well, as you can see, AMD continued to add strength and gained profit, and ACN stayed fairly weak. It didn't do a whole lot, but it gained it moved down enough to generate some profits. So what happened on my pair? Well, just 2 days later, we got the pop, and I actually closed them out. So that was 6/24, June 24th through June 26th. You can see right there, I had the buy August 140 calls on AMD. I had the buy 295 puts on ACN. So I'm buying a call, I'm buying a put. I'm just buying a call on the stronger stock and buying a put on the weaker stock. 2 days later, the AMD calls were up 48%. The ACN puts were up 36%. And I closed them both for a net gain. Now, really important topic here. Hopefully this is making sense to you guys of why we're trading two stocks at the same time. Really important. We have to use options for this strategy. Now, with some of my strategies, especially if I'm directional, I would say you could just trade stocks or options, whatever you like best, but not profit pairs. The key with profit pairs is that we're planning for scenarios where a sector might rally aggressively or fall substantially. And the entire point of profit pairs is to create a net profit from the two assets we're trading together. Because remember, in most cases, we're expecting to lose on one side of the trade, but have a net profit between the two sides. So if you're doing this with the underlying stock, you'll win some of the time if both stocks go the same direction, they continue their trend, or if the deviation between them is massive. But if you're trading it on regular stocks, you'll lose the advantage of leverage, which amplifies the deviation. So it amplifies the separation of the two assets. Let's go through a few basic scenarios just so you understand the importance of using options in profit pairs. So in each example, we'll say that we're long stock A, we're short stock B, and we'll see how they perform based on different scenarios. Example one is when they just go in your ideal direction. So your long stock A, it goes up. Your short stock B, it goes down. Well, if you're trading the shares, you'll still do fine here, right? Because the stock that you're long, you'd make about 10%. The stock that you're short, you'd make about 10%, and your result would be a 10% per dollar risked. Okay, so that situation, you're fine. Now, if you did the options, obviously you'd be a lot better off. Why? Because you'd probably make about 150% return on the call, about 150% return on the put, and your net result would be 150%. Now, example 2 is more common. That's where you're long, ACN, you're short AMD, or vice versa, and they both respond similarly. Well, in this case, if you're doing the stocks, you're going to break even, right? Because you put $1,000 into one, you're up 100. You put $1,000 in the other, you're down 100. You break even. Well, if you have the options, this is where the power is. Because now in that very same situation, if your calls are up 150%, your puts can only be down 100%. They can't be down 150%. They can only be down 100%. And so your net result is 25%. Well, what if the sector collapses? Well, with the stocks, once again, you're break even, right? You have a stock that's down 20%. You have a stock that's up 20%. You break even. But with the options, here's where you can really, really get those outsized returns. Because your call, once again, can only lose 100%. But your put, that might make you 300% if the stock drops 20%. Same thing on the upside, right? Stocks would be break even, but the options would have all kinds of outsized potential. Now, this basic scenario should kind of give you the understanding of why options become so important if you're trading pairs. Now, I do this by using my option as my stop loss. Now, a lot of people get very uncomfortable with this. I have people all the time ask me, Nate, are you really willing to lose 100% of the option value? My answer is yes, but I just risk when I'm willing to lose. I think it's one of the big benefits of options that I can only lose 100%. If I buy a call for $5, I can only lose that $500 per contract. If I do 10 contracts, I can only lose the $5,000. To me, that's actually one of the biggest benefits of trading options, is that I can use that as my stop loss. I don't have to have unlimited risk. So if you're talking about short to medium term plays, one side is capped at the 100% loss, while the other side could generate 150% or 200% or 300%. And so that's actually what puts you in position for that net win, is that one side is capped. You can only lose 100%, but the other side has unlimited profit potential. And you can only do that with options, guys. You can't do that with stocks. Only options can give you that capped premium versus that unlimited upside. Now, of course, it wouldn't be fair to go through all those scenarios without showing you how the losses could happen too, right? The first scenario would just be that we get the direction wrong on both sides, right? So long stock A, but it actually goes down. Short stock B, it actually goes up. That's kind of your worst case scenario. Also, your most uncommon scenario, right? Because once again, we're trading stocks that are paired in similar sectors. The more common scenario is that stocks just remain relatively flat. So your long stock A, it goes up 1%. Your short stock B, it goes down 1%. You're simply not getting a whole lot of movement in each stock. You have what I call flattish movement. Well, in these cases, we're not losing value because of the movement, but simply because the premium on both sides will erode and will end up with a losing trade, right? Because if the stocks just stay flat for the next 2 weeks, you're going to lose premium because of time decay over that span. So those are kind of the scenarios. Your winning scenarios, your losing scenarios, and why we do that. Now, hopefully, you should have a pretty decent overview of how the strategy works just from that, 60 slides or whatever we just covered there, and some examples of how it actually works, like ACN versus AMD. Now, on a future opening playbook, I'll go into the exact steps, how we look at the sectors, how we look at the stocks, but let me just give you the quick overview of the step-by-step profit. I'll even just pop this in the chat for you, just so you have a better idea here of how this step-by-step process is going to work. We're going to compare sectors and find the sector we want to trade, choose that. Then we're going to compare the stocks in that sector and choose which stocks we're going to trade. Then we're going to build the profit pair. And then one of the most important steps is down here. Balance the profit pair. I think I actually already got a question. Someone asked about this. This step 6 is super critical. Why? Well, because if you're trading an AMD call that costs $5 a contract and an ACN put that costs $10 a contract, and you do one contract of each, all things being equal, you might not make a gain. If the ACN trade goes down 100% and the AMD call goes up 100%, your percentages are break even, but you're losing money because you have more money invested on the ACN put than you do on the AMD call. So you have to balance the pair. You have to trade two contracts on AMD to balance out every one contract of ACN. So this requires a little math, folks. If it's $3 versus $9, you need 3 to 1. If it's $2 versus $10, you need 5 to 1. You have to have the same amount of money risked per side, or else all those percentages don't mean anything because they have to balance out. And then understanding trade management, I won't go down the bunny trail too much on that one right now because there's a whole concept there. If it's moving slow, you get out earlier. If it's moving fast, you might wait a little bit longer. But just as a basic rule of thumb, I'm usually looking for about 25 to 30% net profit on a pair trade. So if it gets up and it's showing about a net profit of, 25, 30%, that's usually about when I'm looking to get out. Okay, let me actually give you one pair trade idea, and then I will hand it over to Mr. Tom Busby here. So since crypto is moving, I like the idea of taking some nice high-risk crypto trades. We've been talking about these catch-up trades. So I like I like Mara and CLSK. Similarly, cheap stocks. You can kind of take a flyer on each. But what you can do is you can do Mara long and CLSK short. Trade the stronger rebounding stock long and the other one short. Why? Well, if Bitcoin collapses to 100K, those stocks are going to be down 15% each probably. And your put's going to be up 500% or something ridiculous. But on the flip side, if Bitcoin, goes up to 125K plus and those stocks continue to catch up, Mara might hit $25. It might be up 20% on the stock, and therefore the calls are going to be up. And so even if CLSK puts are way down, your calls can outperform. And remember, then we're going to balance it. So let's just go ahead and look at this real quick. I'm going to pull it up for you here. If I can drag my screen. There we go. Let me just shrink this down. Okay, so here's Mara. I'm looking for Mara. It could be all the way up to 25 to 30 over the next few months if we get a crazy rally. More than likely, it'll probably top out around these recent highs over the next few weeks if Bitcoin doesn't do a whole lot. And then CLSK is actually in a similar position, just not as strong as you can see, lagging a hair behind. I like CLSK. I would actually, if I was trading it directionally, I would trade it long. But in a pair trade, I'm going to trade it short. So go to trade. We'll type in Mara. By the way, I always put in the one that I'm directionally biased on first. So since I'm bullish, I put on the bullish trade first, just in case we get a runner. I want to be in my bullish trade first. I'm going to go through the 16 days, okay, because I'm trading basically what's Bitcoin going to do here just over the next couple of weeks. And then I'm going to go to single. I'm going to trade typically about one strike out of the money, right? Because I want to go for the directional impact on either side. So that would be, in this case, the $20 calls on AMD. So the first part of the trade would be buy the AUG1 $20 Mara call. And that would be at about $1.17. Okay? Then I'm going to flip over to the same expiration and go to CLSK. August 1. And this time, I'm going to go for the puts. One strike. One strike out. That's the 1250. So the second part of our trade is to buy the 1250 CLSK puts at about 70 cents. Okay, so I just posted in your pair trade, but notice those are not the same prices, right? So what you probably would need to do is balance these out. Maybe you're going to do, 2 Mara calls and 5 CLSK puts, or, do more contracts and balance it out even more closely. But to do that, we just have to bring up our good old-fashioned calculator and do the math. So 117 times 2, you would have about $234 on your Mara risk. You divide that by that 0.70. That's how much you're paying on CLSK, and you're going to be fairly close to 3 contracts there. So, if you do that, 3 per 2 contracts of Mara, you're going to be fairly balanced, right? So if you did more contracts, for example, if you wanted to say, okay, I'm going to do 117, so I'm going to do Mara and I'm going to do 10 contracts, I'm going to put $1,000 in. Well, now I'm going to be able to zero that in more closely to CLSK. And I can divide that by 0.7. I'm going to be at 16, so about 17 contracts. So the more obviously you're doing, the closer you can kind of, derive your balance. My rule of thumb is that if you're within a couple percentage points of your total risk, then you're going to be in decent shape on a pair. All right. So there's your pair trade. Just make sure that you balance it so that your risk is similar. And hopefully we get a big pop here on Mare, or we get a big drop here on CLSK, and either one will be in good position to make some money because, once again, your actual option premium there is your stop loss. Can't lose more than 100% when you're buying a call or buying a put, but those other side could easily explode. Now, by the way, guys, someone asked this question. We're not putting this in on one ticket. The broker's not going to let you put it on one ticket. 2 separate trades. Buy the call on Mara, send it off, then buy the put on CLSK, send it off. 2 separate trades completely. All right. Hopefully that makes sense. We did a pretty quick overview there on that trade, and we will do a deeper analysis here sometime in the near future. I will now turn it over to Tom. He's going to walk you through a little bit of what he's been working on, also kind of what his specialty is, looking at the 24-hour market.
Hey, Nate, it's very interesting what you covered, but you can do that in futures also. Okay. And it gave me an idea. I haven't done that in a long time, but it's a great strategy where you don't have to rush in and rush out. Just do the thing and let the money work for you. But you can do it in futures also. So, for example, if you got the yen falling and the euro rising, you can do it the same way. It's a great strategy.
Yeah, that's actually how I first learned about a little bit of the pair trading was from the Forex days. That's kind of where I started learning. A lot of guys did it.
Yeah, I used to do a lot of it. Well, let me get into it. I'm doing a one-on-one today, but I want to take a minute away from Fred and talk for a second because I got something pretty exciting for people. Past performance is not indicative of future results. There's risk in trading no matter what you do. In my opinion, after Monday, the market's going to quit all this rocky stuff, and I think we're going to boom the second half of the year. I think if we can beat the record, it's about 17%. That's what I'm thinking in the second half of the year. And so I've been telling my people and everything that, hey, time to go to work and make some money. Race a lot of sins, right? Get on the right trend. So that's the good news. But anyway, that's what I think in my opinion. Now, I like to show people that how valuable the 24-hour market is, and I do it through the trades that I issue. And so far in July, I haven't really traded heavy. But I was surprised to know that we've done 16 trades and all of them been winners. So that's pretty good if you can do something like that, And but after the 21st, I'll get more aggressive because I believe that this trend I'm talking about is going to make a lot of people a lot of money if they'll listen. I say listen and learn. This is the time to do it. But if you look at the market right now, we come into that period where the E-mini's up about 5.8%. The NASDAQ's up 8.48. The Dow's dragging, always dragging. But Europe's up 21%. Gold's up 26%. And crude is my play of the year. I think crude's going to $45 on crude. And today it's down about 1.5%. So I think it's going to be